Welcome to this installment of Clarifying Tax Situations with attorney and CPA David W. Klossing.
This video is on real estate professionals. Let's start with what is a real estate professional? Well, if you're watching this video, there's one of two reasons you're watching it. One is your tax advisor is telling you maybe you should consider claiming real estate professional status, and you want to know what that means to you. What are the risks and rewards involved in doing that? Or number two, your tax advisor had you take that position and you're now under audit for it, and you're wondering, did I make a right decision in the first place, and how do I deal with this audit? Okay, that's what this video is on. Well, let me start by telling you that investing in real estate is not always the right choice to begin with. Frankly, if you're making above $150,000 a year in adjusted gross income, chances are you're going to wind up with a situation where your losses aren't allowable. Okay. Now, if you have sufficient wherewithal to invest enough proceeds in real estate so that you're not carrying a mortgage, if you could buy real estate outright and it's throwing off income, sure, it's a great investment. You can do 1031 exchanges into the next up-leg property without recognizing tax events. I really like it for that reason. If I had money, I would do that. I could tell you that about 10% of the millionaires in America were made through real estate. I like it. I would do it. The only problem is if you're a wage earner like myself, if you get paid on a W-2 like myself, there are reasons why investing in real estate to begin with may not be the right choice, and we'll get into that. So, first of all, what's a real estate professional? Well, let's start with this. Real estate by definition is passive. If you buy a piece of real estate, an apartment complex, and you rent it out and you're producing rental income and you're producing a profit, that profit by definition is passive, meaning that you don't necessarily actively participate to the point in that activity that it rises to the level of trade or business. It's more on the cusp of, this is an investment on this end of the spectrum, on this end of the spectrum is a trade or business. If you have one piece of real estate, one single family residence, it's hard to argue that you're a real estate professional. But yet if you've got 58 of them and there's no management company involved and you provide all of the labor to make this go, you find all the tenants, you collect all the rent, you make all the repairs, yeah, that's going to start to look like a trade or business. I'm not saying the government won't attack you on that, but you need to understand it's a continuum, it's a judgment call, it's a facts and circumstances issue. And anytime you're dealing with a facts and circumstances issue, the government's got the upper hand. All they have to do is disagree with you. And I can tell you this, I read about 300 cases on real estate professional litigation preparing to speak on this subject. And I can tell you there's one or two winners. Almost all of the case law in this area is losers. And they're a recipe, all those existing cases are a recipe for the government to tear down your real estate professional status, which can be a disaster depending on how much you've claimed in the way of losses from real estate activity. Because all of a sudden you could lose the benefit of all those losses. Not just for the 3-year period of open statute of limitations, but they could go back further if they wanted to. I haven't seen that a lot. So let's get into it. As I said earlier, ordinarily, real estate activities are passive by nature, which means if you're throwing off losses from your real estate activity, as is very common, what winds up happening is that the mortgage interest and the property taxes are usually sufficient to create a situation where you've got positive cash flow coming off the activity, and because of the depreciation, which is a non-cash expense, you can be in a situation where you've got actually positive cash flow from the real estate activity, but taxable losses. And that's what really attracts a lot of people into real estate to begin with. Problem is, what you do with those losses is limited unless you can get around those rules through claiming a real estate professional. But I'm telling you here and now that that's a very dangerous thing to do, and you better make sure you've got your facts straight before you go down that road, because it can be very expensive if it blows up on you. All right, so what is the significance of passive income or passive losses? Well, the tax code makes it so that you can only offset your passive income with passive losses. If you have passive losses from real estate, by definition, you can't take the losses from that activity and offset your active income. Well, a lot of people that find that they have money to invest in real estate in the first place are high wage earners. In other words, you're a doctor, you're a lawyer, you get paid on a W-2, you're making a lot of money, you invest in real estate. You would like to take the losses from the real estate and offset it against the high income that's generating the assets to invest in real estate in the first place. Problem is, the tax code is designed to prevent you from doing that. And let's get into it. Okay, the first carve out, which you might find beneficial, is if your income is between $100,000 and $150,000 of AGI. Okay? Most people in that range, if they live very frugally, could find the money to invest in the second piece of real estate and call that rental real estate. But it's usually people making above that amount. But anyways, if you make between 100 and 150, there is a potential $25,000 offset, even if you don't qualify for real estate professional, special carve out, where you can take $25,000 worth of your passive losses from rental real estate activity and offset that against your active sources of income. However, this exemption of $25,000 phases out. For every $2 of income above $100,000, you lose $1 of the exemption. So between $100,000 and $150,000 of AGI, that $25,000 completely phases out. When you get into real estate professional status, you don't need this $25,000 special allowance to offset your active income with your passive income. By claiming that you're a real estate professional, what you're saying is, I actively participate in real estate to the point where I'm not a real estate investor. What I'm really doing is running a trader business involving real estate. When you make that argument, if you meet all the special rules surrounding real estate professional, you can take the passive losses from your rental real estate activity and offset that against the active sources of income that you're using to generate the wealth to invest in real estate in the first place. This is what makes real estate professionals so attractive, but it's also dangerous. Let's get into it. Oh, let me make one thing clear right here. California does not conform to the federal real estate professional status. In California, the most you're ever going to get is that $25,000 offset. So for federal purposes, to be considered a real estate professional, what's involved? The first requirement is that more than 50% of all the personal services that you as a taxpayer render during a taxable year must be in trades or businesses that involve performing real property trades or real property businesses that you are considered to materially participate in. That's a mouthful, and there's a lot of different hurdles that you have to meet to be considered a real estate professional. That's the first requirement. So the first thing we have to define is what are real property trades or businesses. Real property trades or businesses are those that develop, construct, acquire, convert, operate, manage, or broker real property. The second prong to this test is that you must have performed more than 750 hours of personal services during the year in real estate trades or businesses. The real advantage of real estate professional is that the hours that you put into that trade or business, if they qualify, count towards that 750 hours. Now here's the first way the IRS is going to attack you on real estate professional. For purposes of these tests, personal services performed by a taxpayer or the taxpayer's spouse do not count as services rendered as a taxpayer or an employee in a real estate trade or business unless a taxpayer owns more than 5% of the employer. What does that mean? It means if you get paid on a W-2, even though you're in a real estate trade or business, okay, a business that constructs, acquires, converts, manages, or brokers real property, that may be you may be a real estate agent, for example, but if they pay you on a W-2 and you don't own at least 5% of your employer, that time that you spend in, that 2,000 hour block of time for the year that you spend being a real estate agent, does not qualify towards the 750-hour requirement to be considered a real estate professional. If it doesn't qualify, what does that mean? It means that the actual activity of managing and operating and controlling your real estate investments must come up to the 750 hours on its own, which is tough, and I'll explain why. If you've decided to claim the status of real estate professional, one of the things you need to think about is whether you're going to make a grouping election or not. A grouping election is advantageous in that what you're doing is you're saying that all of the properties that I own are really one activity, and therefore I only have to meet the material participation rules on that entire block of activity, all those properties, once. If you don't make this election, what winds up happening is that the government's going to say you have to meet the material participation tests on each property individually. Ordinarily, they'll come at you and say, I need 100 hours of personal services that qualify for real estate professional on each property that you own per year. That becomes very tough. So it's usually a slam dunk to make the grouping election. But what's the downside of a grouping election? The downside of a grouping election is that if there are suspended losses that are attached to one of your properties, those suspended losses do not become freed up when you sell one property. You have to sell all the properties that you own to free up those losses because it's viewed as one activity. This can be a real problem. So once again, the advantage of making a grouping election is that the taxpayer is going to have an easier time meeting the ownership and participation standards necessary to qualify as a real estate professional. Again, the downside is that on the other hand, the taxpayer may not be able to deduct suspended losses when one of the grouped activities is disposed of. One of the properties within the group of properties is disposed of. You would have to sell all of them, not just a single property, to release any suspended passive losses. You need to understand here that a grouping election is permanent. It's going to apply to that year and all future years unless there's a material change in your real estate operations. Guess what? Being audited and losing real estate professional status is such a change, and at that point you can ungroup or make the election to treat each property as an individual property. To make a grouping election, the taxpayer must attach a statement or declaration on the original tax return for the year that you're going to qualify as a real estate professional and make the grouping election. Okay, we need to say a couple more things about the $25,000 special allowance to make it clear. First of all, in its simplest terms, the special deduction, this $25,000, is going to be equal to the excess of the net losses from passive rental real estate over any other passive sources of income. So first of all, you have to take the passive sources of income, net those to zero, come up with the total passive loss from rental real estate, and that is the amount that's eligible for the $25,000. So it might be more or less than the $25,000. Okay. If the eligible amount goes above $25,000, the excess passive losses don't evaporate. They're carried until the day you have a disposition, and then those losses are recognizable at that point. But you have to be careful about the grouping election rules. You need a disposition of all the properties in the group to set free that loss if you made a grouping election. What's also important to make clear here is you don't get this $25,000 unless you actively participate in the rental real estate. Now, there's a big difference between active participation and material participation. To be a real estate professional, you have to materially participate. To get this $25,000 special allowance, you only have to actively participate in the rental real estate. And as I'm going to explain shortly, these are two different hurdles. One's a lot harder to get over than the other. Okay, active participation is a lower standard than material participation, and thus is much easier to establish. Material participation requires regular, continuous, and substantial involvement in a real estate activity to qualify as materially participating. To actively participate, the taxpayer need only genuinely contribute to the activity in a meaningful way, much lower standard. In this context, some of the activities that wouldn't qualify to meet the material participation standard will qualify to make the active participation standard. Like managerial decisions such as selecting new tenants, deciding rental terms, approving rental expenditures, etc. That'll suffice to actively participate. You will not be considered to have actively participated and then won't qualify for the $25,000 special exemption in the following circumstances. If you own less than 10% of all the interest in the real estate activity, you won't qualify. Or if you're a limited partner, you won't qualify. Lastly, if you're renting your real estate under a net lease agreement, you won't be deemed to have actively participated because by definition, the tenant is responsible for the cost and maintenance decisions of the underlying property. Okay, well here's an important distinction. There are certain rental activities that could be considered active, okay, trade or business right off the bat. And then there are other rental activities that are considered passive. So how are rental activities defined? Okay, first of all, general definition, a rental activity is an activity in which the income is derived from customers paying for the use of tangible property. Here, tangible property can be anything from a 2-day rental of a cement mixer at a rental yard to a 1-year lease on an apartment at the beach. So, an activity can be pulled out of the passive rental activity qualification and become an active trade or business if one of the following 6 exceptions apply. First of all, average use of property. The average rental period for a piece of tangible property is 7 days or less. That will not be considered a passive rental activity. The second exception is where the average rental period is less than 30 days and substantial personal services are rendered to make the tangible property available for rent. Watch out here, a facts and circumstances test is applied to determine whether substantial personal services are rendered. The following factors are looked at: the type of work required, the frequency of providing services, the amount of charges allocated out to the rental portion on the tangible property and the charges related to personal services, etc. A third exception is where extraordinary personal services are rendered, in addition to the provision of the rental aspects of personal property. Personal services will be considered extraordinary when the rental aspect is incidental in comparison to the personal services rendered. The last exception is where the use of tangible property is minor in relation to the taxpayer's non-rental activity that they're paying for. The reasons these exceptions are important is you could be throwing off a loss from an active trade or business rental activity, and that will be deductible against your active sources of income and not limited to just offsetting your passive losses or qualifying for the $25,000 special exemption, or even needing to be called a real estate professional to be able to offset those losses against your active income. Another exception is where you have the non-exclusive customer use of property. That doesn't constitute a rental activity. Let me give you an example. How about this an example? You go to Costco. In Costco, there may be a hand truck available for you to use to get the goods that you're buying out to your vehicle. That is a non-exclusive use of property by multiple people that attend Costco, and as such is not a rental activity. Lastly, these exceptions also apply to an entity, where one of these exceptions is found at an entity level, a partnership, an LLC, an S corporation. The flow-through of that income or loss will keep the same character. If it was non-rental activity at the entity level, it'll be non-rental activity at the individual level. So, in order to understand rental activities in general, you need to understand when a passive activity loss is deductible. In order for a passive activity loss to be deductible, it must meet one of 2 conditions. First, if a passive loss arises in a current year, you have to go through the following. First of all, you got a passive loss. Do you have passive income to offset it against? If you've got $5,000 of passive loss and $6,000 of passive income, you wind up with $1,000 of passive income and you get to utilize it. However, if you have $10,000 of passive losses during the year and only $5,000 of passive income during the year, you've got to figure out what to do with that additional $5,000 of passive losses. The first thing you can do is say, is that $25,000 special deduction available? If it is, you can offset that $5,000 against other sources of active income. If it's not available, the next question is, are you a real estate professional? If you qualify as a real estate professional, you don't have to worry about that $5,000 being allowable against active sources of income. If neither of those are available, the $5,000 becomes suspended. You can't utilize it, but you do get to carry it forward to the following tax years. What you also need to take into consideration is you have to think about the passive losses that are flowing through the prior year's returns into the current year return. That becomes part of the same calculation. When you wind up with a net disallowed passive activity loss, what winds up happening is an allocation is made out to all of the taxpayers' passive activities of their prospective portion of that loss. These accumulated losses per activity can become usable when the activity no longer is a passive activity, when it becomes an active activity, or when you sell that activity. But remember the grouping rules. When you have a total disposition of a passive activity in a taxable transaction, the suspended passive losses may become deductible at that time. However, again, remember the grouping rules. Both the suspended passive activity losses and a current loss on that activity when it's disposed of may be deducted from active and portfolio income at that point. If you dispose of a passive activity with suspended passive losses in a non-taxable transaction or by gift, the losses do not become freed up and may be lost forever. Again, to fully understand this rental activity concept, you need to understand what passive activity gross income is. Specifically, passive activity gross income arises from any activity that doesn't rise to the level of a trade or business, more like investment activity, where the taxpayer does not materially participate in. Nonetheless, in most situations, we're not talking about portfolio income here, interest and dividends, capital gains. To make things even more confusing, portfolio type income derived in the ordinary course of business may be passive activity as well. Passive activity gross income if credited to a passive activity, an activity where material participation isn't provided by the taxpayer. The following items of income do not generate passive income, they generate active income. Income from personal services is active. Oil and gas property gets a special exemption, where that is active even when you're not materially participating. Income from intangible property, where the taxpayer's efforts created the intangible property and those efforts were significant. That's not passive income. Qualified low-income property. Income from qualified low-income housing projects for any tax year during a relief period is by definition active, not passive. Lastly, dividend payments made by the state of Alaska to eligible residents is by definition active, not passive. So how are passive activity expenses and losses characterized? Well, if you're engaging in a passive activity and you have income, that's passive income. If you have expenses, those are passive expenses. You take the income, you compare it to the expenses, you come up with a net profit or loss. That's either a passive income item or a passive loss item on a net basis. Okay, again, why is this important? Because without the benefit of the $25,000 special exemption or without the benefit of real estate professional status, these losses are not deductible unless you're offsetting passive sources of income. To make things even more complicated here, expenses and losses that exceed passive activity gross income in a particular year may be applied retroactively backwards or carried forwards until such excess is utilized. It's important to note here that the passive activity rules apply to individuals, trusts, estates, personal service corporations, and closely held C corporations, but not to S corporations and partnerships. But you need to realize the S corporation and partnership losses are going to carry the same character out at the entity level down to the individual level, and they will apply there. And I mentioned this before, a taxpayer owns an interest in an activity that's a limited partner is not treated as materially participating in the activity by definition. It's also important to note here that a business can be qualified as a trade or business, but if a participant in that business does not materially participate in that business, you can still wind up with passive income. Investing in the capacity of a limited partner is a good example of that. Also, if you're a 2% shareholder in a major corporation and you're not providing any services, you're not part of the management team, you're not making the decisions, ongoing operations of that business, it's passive to you. Again, material participation means that the taxpayer is involved in the operations of that business on a regular, continuous, and substantial basis. Moreover, this determination is made on an annual basis, year by year, and it can change from year to year. Again, passive activities include rental activities, most rental activities, unless they meet those exceptions by definition. And what's important to note here is rental real estate is passive even where the taxpayer materially participates, by definition, unless their participation rises to the level of a real estate professional, in which case it won't be a passive activity anymore. And the whole point here is that a taxpayer usually cannot deduct the losses of a rental activity, even where he or she materially participates. Remember what's involved in being a real estate professional. A taxpayer's rental activity is not a passive activity if the taxpayer, one, materially participates in the activity, and two, most importantly, number two, performs qualifying services in real property trades or businesses to pull you into that real estate trade or business category. The bottom line here is that real estate professional is largely based on the facts and circumstances analysis, and you're at risk if you take that position and you're wrong. All right, well, let's get down to the nitty-gritty here. If material participation is so important, what qualifies as material participation? Well, let's get real general here. Participation is defined as any type of work a taxpayer does in connection with an activity where he or she owns an interest in that activity. However, to be considered material, this work must be regular, continuous, and on a substantial basis. What's helpful here, for purpose of determining a taxpayer's participation in an activity, a spouse's activities can be attributed to the taxpayer. The regulations under 1.469-5TA delineate 7 tests to determine whether a taxpayer is involved in the operations of an activity on a regular, continuous, and substantial basis. However, only 6 of these tests are applicable to rental real estate activities. If a taxpayer meets at least one of these following 6 tests, they will be treated as materially participating in a rental real estate activity during that year. But remember, that's not all it takes. So let's go through the 6 tests that apply to rental real estate. The first test is the 5 out of the preceding 10 years test. A taxpayer will be treated as materially participating in a rental activity for the current year if the taxpayer materially participated in a rental activity for any 5 years, which do not need to be consecutive, by the way, during the previous 10-year period that immediately precede the current taxable year. The next is the substantially all test. A taxpayer whose participation in a rental activity for the current year constitutes substantially all of the participation in the rental activity by all individuals involved with that activity during that tax year, and this, by the way, includes individuals who are not owners of an interest in that rental activity, they can be treated as materially participating in that rental activity. But be careful here. If you hire an outside service company to come in and manage those properties, they qualify towards that substantially all, which means you wouldn't. The next test is the not less than others test. What's interesting to note about this test is that if the IRS comes along and says you have to meet the material participation rules on a property by property by property basis because you didn't make a grouping election, this is the test that they're going to apply to you. A taxpayer who participates in a rental activity for more than 100 hours, be careful here. Not everything you do related to rental activity will qualify for any of these tests, and we'll get into that. This is how the IRS burns you down here. So again, a taxpayer who participates in a rental activity for more than 100 hours during a taxable year, whose participation in a rental activity is not less than the participation in a rental activity of any other individuals for the year, including individuals who are not owners of interest in the rental activity, is treated as materially participating in that rental activity. What does that mean? For each specific property, if you haven't made a grouping election, you have to put in 100 hours of qualifying services. And the second thing is, there better not been somebody that put in 101 or more hours than you did. The next test that we have to consider is the 500-hour test. A taxpayer who can prove that they participated in activity for 500 or more hours during a tax year will be treated as materially participating in that rental activity. The next test is the significant participation activities test. A taxpayer is treated as materially participating in a rental activity if the rental activity is a significant participation rental activity for the taxpayer for that tax year, and his or her aggregate participation in all significant participating activities exceeds 500 hours for the tax year. A significant participation activity is a trade or business activity in which the taxpayer participates for more than 100 hours during the tax year, but does not otherwise materially participate within the meaning of any other of the 5 tests applicable to rental or real estate. The last test is the facts and circumstances test. If a taxpayer does not satisfy any of the tests that we've looked at, he or she can still be considered to have materially participated in the rental activity for the tax year if, based on all of the facts and circumstances, the taxpayer participates in the rental activity on a regular, continuous, substantial basis for the tax year. But then they swing back to that 100 hours, which I told you was significant. For this test to be satisfied, however, the taxpayers must participate in the rental activity for more than 100 hours during the taxable year. All right, everything I've discussed up to this point was to put you in a position to understand how the IRS is going to try and come at your real estate professional status if you claimed it in the past, and why they're going to come after it. If they come after it and they get rid of it, let's say you were deducting $100,000 of real estate losses a year, and you were making $300,000 of AGI a year. Well, first of all, since you're making $300,000 a year of AGI, the $25,000 special exemption for passive rental real estate losses isn't available to you. Well, if they get rid of your real estate professional, all of a sudden that $300,000 loss is gone. You have $300,000 more of taxable income, and the government has a big windfall, plus penalties, plus interest. If you really want to know everything I know about how the IRS attacks real estate professionals, there's an audit guide. All you have to do is go to the website, irs.gov, go to their website, punch in audits of real estate professionals or audit guides real estate professionals, and see what comes up. When you read that audit guide, it is a step-by-step how-to for the auditor to follow to kill your real estate professional status. The auditors know that most likely appeals is going to back up their play. Why? Because appeals knows there's lots of case law out there on this issue, and most of those cases are losers, where the IRS has successfully killed somebody's real estate professional status. So what's the most common way that the IRS comes in and kills your real estate professional status? What they'll do is, if you haven't made a grouping election, they're going to come after each property that you own and make you prove to them, to their satisfaction, that you materially participated in the running of that property. What most people get in their head is they have to meet that 750 hours of material participation, and they'll keep time logs that are amazing to me. 780 hours, 790 hours, 810 hours. It seems like people keep records just to the point where they can get over the 750 hours and then that stops. The problem with that is the IRS is going to go in and parse through that activity, and there are certain things that don't qualify towards the material participation that they're going to toss. The moment they get you below 750 hours, they're going to yank your real estate professional status. If you've made a grouping election, you would think The normal person would think, all I have to do is meet the 750 hours test on all of my activities, and I'm going to sustain real estate professional status. What they're going to do is properties that are at a distance to you in other states, for example, they're going to look at that and say, now how have you been getting over there to take care of that property? They're going to be looking at whether there was property management companies involved. They're going to be looking at whether you had a manager on each property. They're going to be looking at who was actually doing the day-to-day services to make this activity work. If it wasn't you, they're going to try and take it away from you property by property, even though you've made a grouping election. So here's what happens in real life. First of all, they're going to try and attack you on real estate professional status. We'll get into how they're going to do that in a minute. If they can't beat you there, they're going to come after each property. And what they're going to do in practice, they're going to argue that you have to meet a 100 hours of material participation test on each property. This is kind of hard when you've got a single family residence, for example, that may not take that much work to keep it going all year. To mitigate this 100 hour per property test that they're going to apply on you, a grouping election helps, but that doesn't mean they still won't get the law wrong and still come after you for the 100 hours per property, even though the grouping election says you don't have to meet an individual property by property test for material participation. All your properties go to material participation, but I'm talking the difference between theory and real life, what I've seen in audit after audit after audit. This grouping election is made by attaching a statement to the income tax return where you are first declaring that you're a real estate professional. You should also at the same time make a grouping election under Code Section 469C7 Cap A. Okay, the next way they're going to come after you is by making you provide contemporaneous proof of time spent on real estate activities. Contemporaneous means as you were providing each activity, you were documenting the activities you were providing. Contemporaneous. When you look at the 300 and something cases that I've looked at, the most common reason the tax court threw out real estate professional is when it came time to actually prove material participation. If you couldn't put up the documents to prove the contemporaneous timekeeping requirement, you lost. So what's the IRS want here? They want contemporaneous time logs that substantiate the time you put into a rental activity. Okay, at 2:04 p.m. I began installing a sink in Unit 3. At 4:52 p.m. I finished. Who actually does that? You know, what's really ironic here is the regulations state that a taxpayer's participation in activity may be established by any reasonable means. Well, what you consider reasonable and what the government considers reasonable under audit or in litigation are two different things. Moreover, the regulations say that contemporaneous daily time reports, logs, or similar documents are not required if the taxpayer can establish their participation by other reasonable means. This isn't what happens in real life. Don't count on the regulations to save you. It's the application of the regulations in real life that's the bar that you have to cross. So what's the bottom line here? What really is other reasonable means? It means you have some method to identify the services you were performed over a period of time and the approximate numbers of hours you spent performing those services during that period of time. And this can be based on appointment books, calendars, or narrative summaries. That's normally how people do it. Okay, so the most important thing I can tell you is if you claim to be a real estate professional, you better be documenting the heck out of what you do. Keep it on a calendar. I would have a full-on time log that said I started something at this time and ended at that time. Describe what you were doing and how long it took you to do it in minutia and be able to support that with receipts. If you installed a toilet seat, have a receipt for a toilet seat. If you put on a doorknob, have a receipt for a doorknob. But here's where most people burn down. Not all activities count as material participation for this 750 hours test, for the 100 hours test, for any of the tests that I was describing. This is how this stuff is applied in real life, and the tax court and appeals are backing up IRS audit over these items. Let me go through it. Here's the problem. We have this body of judge-made law where different judges have come in and said this activity does not qualify. The time you spend doing this activity doesn't count towards the material participation testing hours you need to be seen as a real estate professional, or in a property by property basis materially participating in that property. Auditors are aware of this case law. Matter of fact, if you go read the audit guide I'm telling you to on real estate professionals, it lists all of the activities and the case law it came from that said this doesn't count towards that testing. So what activities don't count and will be taken out of the testing? You won't be given credit for this time, even if you can substantiate it. This is the one that really blows my mind, and it seems to be a catch-all they can nail almost anybody on. But here it goes. Time claimed for work that is not customarily performed by the owner of rental real estate, but the owner put in this time doing these tasks that owners don't ordinarily do simply to meet the material participation standards. You put the time in, but you did things that most owners wouldn't do. That's enough to throw that time out. Oh my God. Here's the next squishy concept they can get you on. Time claimed that an investor in real estate would normally put in. Okay? If you're investing in real estate, what are the activities that you go through to determine whether an investment in real estate is a good investment to make or not? Well, you're looking at comparables, you're looking at market rents, you're looking at trends, you're looking at numbers, you're looking at financial statements, you're looking at accountings. These types of activities don't count unless you can also show that you're materially participating in the day-to-day operations of the property. Some auditors just take this time and toss it, as I'm going to explain in a minute. These are the type of activities that get tossed out of that testing. Again, you come in at 780 hours, all they have to do is parse out 35 hours, and you don't qualify for a real estate professional. In my experience, the following are the activities that auditors try and commonly parse out from the material testing and say that time didn't count to get you below the 750 hours. Time spent studying or reviewing the financial statements of the rental operations, they'll try and parse out. Time spent preparing or analyzing any type of summary of the operations of the property in general will be parsed out. Time spent preparing budgets, making phone calls, visiting the property, doing a site visit to see if it's operating efficiently will be attempted to be parsed out. Time spent writing checks, time spent going to the post office, time spent going to the bank related to your rental activity will be parsed out. Time that you spend preparing Schedule E, which is how you report rental activity profit or loss on a tax return, they'll parse it out. Time that you spend organizing your records, reading journals, monitoring the finances of operations. Anything that they can say you are acting in a non-managerial capacity will be parsed out. It's very interesting to me to note that activities listed above are fully recognizable for material testing purposes where a rental activity rises to the level of a trade or business, but are routinely disallowed and treated as non-countable where the activity is deemed to only rise to the level of investment activity, which is really where this is at. You got that continuum. On this end of the continuum, your involvement in real estate isn't substantial enough to make it trade or business activity. It's investment activity. On this end of the spectrum, your entire life is about rental real estate. All you do involves rental real estate. That's trade or business. Here you're a real estate professional, here you're not. On-site management. If you have an on-site manager and an on-site maintenance team, man, that's a kiss of death. All right. How about if you've got a property management company? That can be the kiss of death. All that time put in by others works against you. Let me explain. The IRS routinely takes the position that if a rental activity has an on-site management team, it makes it very, very hard, in their opinion, for a taxpayer to materially participate because rental activities by nature do not require significant day-to-day operations or involvement. And therefore they're not time intensive to begin with. But if you have other people putting in the time necessary to work that activity, how can you materially participate? This is their attitude. The IRS is going to take the position that because of the on-site management team, the only of the 6 tests that I went through earlier that you can possibly pass to call it a real estate activity, a deductible real estate activity, a real estate professional real estate activity, is the 500-hour test because of the on-site management. And that'll be on a property-by-property basis. Even if you've made a grouping election, this is how they applied in real life, even though that's not correct. First thing they're going to do is look to your other activities and say, is there even 500 hours a year available in your life to provide these activities? Well, let's see. You're a full-time employee. You typically work 400 hours of overtime. Well, that's 2,600 hours approximately of the tax year already gone. Where do you find 500 hours to do this? Auditors are known to equate on-site management with an off-site management investment company. You know what's important to note here is that property management companies offer services on an a la carte basis. You can have them as involved in that rental property as you want them to be, from doing everything for you to only doing a special part of it. I had a client once where his rental properties were in a bad neighborhood, so he hired a property management company to go in solely to collect the rents. That involvement was enough to call into question whether he actively or materially participated in that property, in that audit. By that example, if the only thing the management company is doing is collecting the rents, that leaves plenty of activities for the owner to do to qualify for material participation. The auditors are specifically trained to look for indications of on-site or off-site management. All they have to look at is who's you're cutting checks to. They're getting paid, they're providing some sort of management, that's bad. The auditors are trained to scan the commissions that you deducted, the management fees that you deducted, the expenses for cleaning apartments, for maintenance, any type of maintenance that you're paying for, any type of repairs you're paying for, all of that works against you. This is all activity provided by somebody else that you can't claim you did to qualify for the material participation rules. Bottom line is this: each activity, each service that was performed to keep that rental activity going, that was provided by a third party and not by you, works against you. You can't qualify as materially participating if there's a whole bunch of evidence that everything was done by third parties. Okay, I think I alluded to this earlier. The IRS is going to attack you right off the bat if you're a full-time employee. Here's how they're going to do it. First thing they're going to do is look for a W-2. If you got a W-2 reported on your return, you're an employee, period. End of story. Here's where you get screwed. There's case law that says the following. Even where you're providing personal services in a real estate trade or business, which would work towards becoming a real estate professional, if you don't own at least 5% of your employer, those hours you spend as a full-time employee or a part-time employee in that real estate trade or business don't qualify towards the 750-hour test, which means all 750 hours have to come from providing services in the capacity of a real estate professional, materially participating. And each one of those hours has to qualify and not get parsed out as they're doing the math. Auditors take this very blatant position. If you're a full-time employee, that requires 2,050 hours a year minimum, which leaves little time for you to come up with the 750 hours in your life to meet the real estate professional status because of material participation. All 750 hours have to come from actually participating in your rental real estate activities. You get none of those hours from being in a real estate trade or business if you get paid on a W-2 and you don't at least own 5% of your employer. You know what's really important and frustrating to me is that this 750 hours requirement is not impossible to meet, even if your time spent as a full-time employee doesn't count. But in an audit, they will routinely treat it as I want right off the bat. Because you get paid on a W-2 and you don't own 5% of your employer, there's no way you can find the time in your life to meet that 750-hour test. I win, you lose. That's when you need to hire someone like me. It's a rebuttable presumption. So what's the bottom line in this area? If you get audited over a real estate professional and you see that all the things they're asking about at the beginning of the audit surround your real estate activity, they're coming after your real estate professional status. If they get it, you're looking at least 3 years where they're going to go and remove the deductions related to rental real estate losses that offset your active income. The more entrenched and the larger those losses, the more it's going to cost you, the more you need to fight this. Now listen, I can tell you that a lot of these audits are losers. If you don't have the evidence to prove that you materially participated, first of all, fabricating that evidence is a felony. I'm not going to have you do that. You need to keep those contemporaneous time logs. Most people don't think about it until they've already burned down on an audit. At that point, it's too late. So, this is a fight that can be won, but it's not an easy one. And you really need to hire someone who's dealt with a lot. I have. And guess what? If it is a crash landing, if you are going to lose that, you want somebody that's not going to go tilt at windmills, run up a bunch of legal bills, and you have those bills in addition to losing real estate professional status. I won't do that to you. Anyways, thank you for watching this video, and if you have any questions, I'm more than happy to speak on these topics.
Thank you so much again for your time and interest in how we may be able to help you. Please don't hesitate to call if something is worrying you. We would be very happy to help. Just call or email for a reduced rate consultation.